the expected spending is going to be down year over year. So this is the first one in several years of the survey. It had been plus 16, then plus 8, and now it's down 10 on an per student basis that people are planning to spend on back to school. So not only is it shifting forward, but it's planning to be down in terms of people's expectations of spending. And I think it's interesting on the next slide here, you have 68% of people said spend same or less year over year. So there's a portion that said spending more. But if you ask them, why are they spending less, right? They said spending less. Why is that? It's because they have less money to spend was the number one answer. 51% said that. And then on those that are spending more, why are they spending more? 75% said just because prices are higher, right? They're not planning to actually buy more things. They just have to spend more because things cost more. So the aggregate read there, I think, is bearish on what back to school is going to look like. And again, we think it's shifting earlier here and going more towards Amazon Prime Day. So you have steepening compares, I think an aggregate hit on what the back to school season is going to look like. And then, after we get through these couple months of like shifted earlier back to school and reduced spending, right? That's when like October, you have the student loan payments coming back online. So, and you have, over this aggregate time period, you have that higher FICA tax hit to this sort of consumer if they make over $150,000 year over year, they'll be spending more in Social Security tax. So, this is a time period here where we think you got 3-4 months of deteriorating spending in discretionary retail.
This is the most obvious setup from the top end of the XRT risk range, top 3 in 20 years. And by the way, January of 2022 was also in the top 3 because that's where there was a 100% chance we're going to enter quad 4 coming out of January and of that year. But this is I probably put Q2. The bounce in Q2 of 08 in the top 3 as well. But a lot of people didn't even, a lot of people are on this call, let's be clear, because they got annihilated in 2008. They don't want that to happen going into 2024. So again, this is very obvious.
But the reality is that, tenants are subletting, tenants are dialing back their leasing activity, they're subletting some space, and growth is slowing from astronomical levels. So like what's going to happen, I think, is in Rexford's case, where they had been printing these crazy high 60 to 75%, rent changes on new leases, that's we think it's going to decline to 30%, which, by the way, is a great number on an absolute basis, but it's also getting cut in half. So the second derivative is rolling over. People are kind of figuring out that these markets are decelerating, and obviously, on the margin, that's what drives stock performance.
Like I said on U.S. retailers, this is the easiest setup now because you have XRT pretty much at the top end of the range. Real estate last week was at the top end of the range. But this is why, once you get through this options expiration gamma squeeze, that all this stuff's going to be like bag holder central. I mean, it's going to be like Leslie Pools down 17% in a straight line.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.